Hi, this is Alberto Pau speaking, back from Brazil, speaking from London, UK, and today I would like to tell you 7 quick ways to evaluate your trading system now. So let's get started. First of all, you want to look at the win to loss ratio. This is the average of the winning trades divided by the average of the losing trades. It effectively gives you an indication if on average you're winning more than you're losing. The key word here is on average. However, bear in mind it doesn't give you the full picture. It doesn't tell you how big your winning trades are versus how big your losing trades are. It just tells you on average if you're winning more than losing. The second thing you'll be looking at is your average wins and losses. Fairly self-explanatory. This is the average of your winning trades and the average of your losing trades. Before, we were looking at the ratio of the two averages. Now we're looking at the two averages individually. You obviously want to make sure that you win on average more than you lose. The key word here being on average, but let's look at an example. Say you have 200 trades in your backtesting and you're losing on 150 of them and you're winning only on 50 of them. Then obviously your win to lose ratio is 25 to 75. But that's not enough to determine whether the system is good or bad. If the average wins were $2,000 and the average losses were $500, you are still making money. So here we have an example of how you can have a win to loss ratio that looks really bad, yet when you look at your average wins and your average losses, you're still profitable. The example here is that if you lose $500 on 150 trades, but you make $2,000 on 50 trades, you're still making a profit of $25,000. And effectively, this is the equation we have here, right? Just this bit here, right? It proves you how mathematically, by having 150 losing trades and having 50 winning trades, you can still make money. Let's move on. The third factor to evaluate your trading system is expectancy. It's effectively the expected return on every dollar risked in your trading system. It effectively gives you the profitability of the system independent from the size of the account. It's different from the risk-reward ratio in that it gives you the expected return independently of the amount of risk as well. So it's independent not just of the account size, but it's also independent of the amount of risk you're taking. And you've got to be careful about this. So say your system has an expectancy of 0.75. It means that you can expect to make 75 dollar cents for every dollar you risk. As a rule of thumb, if you can make an expectancy of above 0.60, you are heading in the right direction. The fourth element is the maximum number of consecutive losses. Effectively, look back through your backtesting at how many losses your system had whilst still being profitable. This statistic is key, as it will give you confidence through those losing periods when it feels you should be throwing the towel. Let's look at an example. Let's say your system has 6 losses in a row. Without knowing that, based on historical data, the maximum number of losses for your system is 10, and the system will still be profitable, a naive trader would give up. But because you know that statistically your system can have up to 10 losses in a row and still be profitable, if your system has 6 losses in a row, you'll still be comfortable that the system is valid. Number 5 is the maximum drawdown. This is effectively the top to bottom performance or loss of your system, regardless of whether it happened through a series of consecutive losses or not. The key question here is, are you comfortable with the size of the loss? If not, then you should look for a system that you can live with. The example is you could have a system that generates you, say, 200% return, but before getting there, it loses 80%. Would you be comfortable with that? Effectively, knowing that if you invest $1,000, you could lose up to $800 before the system makes you $2,000. Number 6 is the number of trades. You don't want to have a system that gives you too many trades or too few trades. You need a system that gives you a number of trades that you can realistically handle. If a system gives too many trades, you'll be forced to choose between signals, and that will create ambiguity, and you don't want that. If a system gives you too few trades, your capital may not be fully utilized, and you may not be taking advantage of all the market opportunities. Remember, how I mentioned in a previous video, you should look at investing no more than 2 to 3% of your account equity in any given position. Number 7 is profitability, obviously. And this is simply defined as the return on investment over a year. If the investment horizon is shorter, then you annualize the return to have a comparable number. Effectively, by taking all profitability numbers as a percent return per annum, you can compare on an equal basis the profitability of different trading systems. This is obviously the most important metric, but it's not the only one. It needs to be balanced against the 6 other metrics. If you're not on my newsletter yet, and you want to get a free gift, I'm giving away a free Forex Trendmaster indicator. You can sign up today on http://vip.myforextradingsuccess.com. This will show you how to make hundreds of pips as we face the largest rally in history. So don't delay, get your free Forex Trendmaster indicator at vip.myforextradingsuccess.com, and I'll see you on the other side. Take care, this is Alberto Pau, I'll talk to you next time.